Hi, this is Brian Bortz, one of the partners here at Kane Waters, and I am joined today by the Managing Director of Tectonic, Brad Sanders, and we are here to give you the December month-end investment update, along with the 2024 year-end investment update. Okay, so let's start with the month of December. December was a pretty interesting month. It looked like at the end of the election results that the market was headed up. Everything looked to be in good order. And then the Fed decided to step in and make a few comments. They did cut interest rates, but their comments led to a reversal in the markets. Ending the month, the S&P 500 ended up being down 2.7%. Global stocks, as measured by the MSCI index, was down 2.4%. Domestic bonds were down 1.6%, and global bonds were down 2.2%. So, kind of across the board, stocks and bonds down for December. Everything looked so good after the first week or two of November. What happened?
Well, the Fed came out and said, basically in short, that they're cutting interest rates by 25 basis points, but then they said due to the potential for tariff policy under the new administration, which is what they really highlighted the most, and continued economic strength, that they were anticipating the pace of cuts to moderate in 2025. So everybody, expected a full percent of rate cuts for the year. They threw ice cold water on that. And then they basically kind of talked around the idea that rates may have to go back up. And that was the moment the market really tipped. Interestingly, the S&P is down 2.7%, ends the year up 25%. But that doesn't really tell the whole story. That's the cap-weighted index. The top 10 stocks in the S&P 500 make up 40% of that index now. So the other 490 make up the whole other 60%. If you look at the market broadly, if you do the S&P 500 equal weight index, that's you give all 500 companies the same share, that was down 6.3% in December. So a pretty rough month. Outside really a couple stocks, Tesla and Nvidia and a couple, really drug this market along for the whole year. And we're starting to get pretty concerned about the concentration in the market. We have a lot of historical data. This has kind of happened a handful of times. 1929, which was the Great Depression, happened right after that. Not a great data point. The Nifty 50 in the 70s, which you had a bad recession after that, and then .com in 1999 and 1998. 1999, excuse me. Those are the last examples where you got a market concentration in the indexes that is this heavy. Now, interestingly, and I think good, is that this market most resembles the .com, and people kind of forget that between 2000 and September 11th in 2001, the breadth of the market did awesome. If you were all in .com stocks and internet stocks, you were down 70%. But the value stocks, kind of the rest of everything, was up 20+% in 2000, another 20% in 2001. And it was just the money had to move out of .com and go somewhere. That's kind of where we are now, where you have a handful of companies dragging the market along. In fact, if you take the Mag 7 out of the S&P 500, 2023, the S&P 500 was up 26%, 26%, somewhere in there. It would have only been up 4.1%. If you take them out for 2024, it would have only been up 6%. So that just gives you an idea of how much those stocks are making up the returns of this market, and the breadth of the market would have been really pedestrian by historical standards. So something needs to shift here.
So it's kind of a little bit of a self-fulfilling prophecy with a weighted index. If you have a lot of people investing in indexes, investing in ETFs, investing passively, where you're buying more of those companies at the top, and that's somewhat of a driver too. One more question for you, Brad, is you had mentioned earlier that one of the reasons that things happened in December the way they did, and we ended up negative, is after the Fed made their comments, there was some concern or some potential concern about interest rates actually going up this year. What would trigger that?
I mean, really, if we continue to grow, the new administration is going to have heavily expansionary policies. So if GDP really starts to heat up and you get a bump in inflation, they are going to have to raise rates. Tariffs are inflationary. I don't care what people on TV say. You can read some websites that try to convince you otherwise. They just are, okay? The cost of the tariff is borne by the consumer, which means the prices go up. Companies don't just leave their prices the same and make less money. That's not how capitalism works. So you will have inflation. It's just to what degree. And to what degree is it's offset. Now, they're not going to put tariffs in day one and then inflation's going to jump the next month. It's not a linear progression. But if you get inflation inching back up over getting close to 3.5% again, the Fed's going to probably have to start raising rates again. That's a big fear out there. The kind of the Goldilocks scenario here would be you get a moderate bump of inflation that keeps it hugging around 3%, and you're able to work interest rates down 25 to 50 basis points at 2025 if everything kind of goes swimmingly and growth doesn't moderate too much.
And thinking about that and hearing that, just not everything is roses, but let's repaint the picture for 24 and let's look at what happened in 24. The stock market itself, even though it was very concentrated in the top 7 positions, the S&P 500 was still up 25%, and that marks back-to-back years that the S&P was up over 20%. So we've been in the middle of a pretty good equity run right now, but really it's highly concentrated at the top. Global stocks, international stocks were up about 16.5%, 16.4%, and domestic bonds were up for the year 1.3%. So if you think about that, it's a little bit of a lag there looking at domestic bonds. As you have a Fed that has been lowering interest rates, you would have expected bonds to perform a little bit better, but they were up about 1.3%. And then globally, bonds were down 1.7%. So that's 24. So given the fact that we've had the last 2 years where you've had a stock market that's increased over 20%, it's concentrated at the top. Kind of when Kane Waters talks to our clients, we're talking about diversification, about breadth, about having exposure to smaller companies, mid-sized companies, growth companies, value companies, international companies, private equities. So if going into 25, we have a situation where something happens to those 7 stocks, how do you think the portfolios that Tectonic helps to advise on will react?
It would be a tremendous tailwind for our portfolios. And I don't think anything really nefarious needs to happen to those companies. But trees don't grow to the sky, right? So if you just start doing math, NVIDIA's a $3 to $3.2 trillion company. If you start saying it's going to be up 100% again this year, well, now it's a $6.4 trillion company.
Trillion with a T.
With a T.
Wow.
Annual U.S. GDP is around 24 to 25 trillion. So you would have one company that's 25% of annualized U.S. GDP. And now you've got 6 other ones. You start adding them up. If they all were up 100%, they would eclipse U.S. GDP, just 7 companies. And so, trees don't go to the sky. Nothing nefarious has to happen. This is a big momentum trade. And as we've all learned, by doing this for 2.5 decades, momentum can shift like that. And it may just be as simple as, those companies, the top 10 or 40% of the index, maybe they go to 30% of the index this year, right? That doesn't sound like that dramatic, and it's not terribly as painful. But that's $5 to $6 trillion that's going to come out of 6 companies, and it's going to go somewhere. People in their brains have this idea that the money just goes in the mattress. No, most of this money stays in the market. That's precisely what happened in 2000. The NASDAQ in March of 2000 popped. Tech.com stocks went down 70%, the NASDAQ did. But value stocks are up 20%. Well, why? Well, because when you sold your Pets.com, if you were lucky enough to sell it before it went to zero, you said, I've got to put this somewhere. Hey, I'm going to go buy Home Depot at 5 times earnings. And the market's set up the exact same way, where that money will go into other productive parts of the market. And there's a lot of areas where that money can go. And that's a tremendous amount of capital that could just go into the breadth of the market. And you could see a year where the S&P 500 equal weight, instead of underperforming by 12% like it did last year, outperforms the cap-weighted index. You end up having another good year unless you're sitting around just buying those 5 or 6 companies.
Yeah, so I would say in short, our portfolios are positioned to take advantage of a broadening market if that happens. We're going to wait and see what the Fed does for this year. We're worried about inflation a little bit rearing its ugly head again. And I think the key word for the first quarter of this year is going to be volatility.
Yeah, I think if you look at the new administration, if you look at something, it just takes one thing, DOGE, right, the Department of Government Efficiency. I think everybody can agree that you want to get rid of wasteful spending. Like, that's what Kane Waters tells clients to do all day long. And so you would obviously want the government to do that. But if you take $2 billion in a budget and you just slash it, that money was going to be spent somewhere, right? That's not going to be spent there now. And those are jobs that are going to get moved around. And so it's going to be bumpy. I think, it has the potential to benefit all of us as investors and just as U.S. citizens. But to think that it's just going to be like a breath and then it's over and everything's going to be great, I think is a swan song. I think you're going to have to kind of suffer through a little volatility. The market's up 45% in 2 years. I think we can deal with a little bit of volatility over the first quarter, 6 months of the year.
Yeah, and I would say, for you guys listening, keep tuning in. Things are going to change on a month-to-month basis, and we'll be here to let you know what happens. So, again, thank you guys very much for your time today.